Hey guys, wanted to take a few minutes today to discuss why I feel real estate is a great investment vehicle. I won't say I think it's the very best investment vehicle out there. I'm sure there's something out there that I don't know, but I will say that to my knowledge, for the lay person, for the everyday person, for what they have access to, I feel it is the best. I will say that. And I want to lay out why. I want to talk about three things that real estate has that make it the best investment vehicle, or something that I think you should look at long term. We're going to talk about the concept of leverage. That's number one. Number two is the tax advantages of real estate. And number three is that real estate has everything a stock or bond has. And it's all in there along with the first two. So let's get into the first one, the concept of leverage. Leverage can be thought of simply as debt. Okay? Leverage equals debt. Whenever I say leverage, think of debt. However, in real estate, maybe some of you guys have bought a house. Maybe you put 10% down, 15% down. The bank then gave you the other 80, 85%. However, you didn't get 10 or 15% of the asset or the house. You got to use the whole house. Now, in your home, you had to pay the bank off over whatever the amortization was, 20, 25, 30 years. But in a rental property, if done correctly, your tenants should pay that mortgage. So no money out of your pocket. You get to play with the entire asset right away, not just your little portion that you actually own. The bank lets you do use the entire thing, and as long as you make your payments. So let's run through a scenario that didn't do a good job of explaining, but let's run through a scenario about how powerful this is. Let's say you have a $100,000 house, to make it very simple, and you buy this, and it's a rental property, and you put $10,000 down, and you finance 90%. So you're into this, your measurement on your return of your money should be $10,000. In year one, let's say you put this on a 20-year amortization. Most commercial amortizations for residential rental real estate property will be 20 years. In 20-year amortization, in year one, you'll roughly pay off about 3% of the principal. If you've ever seen an amortization table, the beginning of it, you're paying a lot of interest, not a lot of principal, and then near the end, you're paying a lot of principal and not so much interest anymore. So in year one, you actually only pay off about 3%. You would think it would be 5, but it's not. It's 3. And near the end, it gets up to about 6 or 7%. So year one, you pay off 3% of your mortgage. Your mortgage is $90,000. Now, at the end of year one, it's down to $87,300. You paid down $2,700 of that. Now, just on that example alone, if you were to sell the house at the end of year one for $100,000, you'd have to pay off the $87,300, and you would get $12,700 back. Now, there's other things, right? This is a very simple example. There's realtor fees, there's closing costs, there's taxes. But for my scenario, you just made a 27% return on your investment. And you'd think that you just paid down 3% of the asset. I should explain that. But again, you're measuring that against only your $10,000. You don't need to measure that against the $100,000 house. So that's a 27% return in year one, just based off of simple pay down. Now, real estate over time consistently goes like this. There's little dips, 07, 08, very big dip in the real estate market. Biggest one on record, but over time, it's an appreciating asset. So let's say that in this year one, your property went up 1% in value. 1% in value for real estate is historically on the very, very low end. But let's, for the sake of a conservative example, let's use 1%. So your $100,000 house at the end of year one is now worth $101,000. Not a huge increase, but again, let's talk about your leverage now. To you, even though it just went up 1%, to you it's not 1%. To you, it's 10% because it's $1,000 against your $10,000 return. So we have $2,700 pay down of your mortgage. We have a $1,000 increase in value after year one. That's $3,700 on your $10,000 investment. That's a 37% return year one. That's pretty cool. Can you get that in the stock market? Yeah, you could. Would it be a very phenomenal year if you got that? Absolutely. That would be phenomenal. If you could sustain that, you would be writing books and teaching seminars. This doesn't take any PhDs or any knowledge. That was a very basic example. Now, let's talk about one step further. Another return you get with real estate, and what I love to invest for, is cash flow. On this $100,000 house, let's say that after everything's all said and done with your rental payments, and this is, I would say, about average for a $100,000 house, which you could expect. I have more, and I think maybe I have some that are a little less around this price point. But let's say after mortgage, taxes, insurance, management, maintenance, utilities, you have $100 a month left over. $100 every month for 12 months is $1,200. You need to add that to your return. That's cash flow. Think of it like a dividend that a stock pays. But again, it's $1,200 measured just against your 10. So that alone is a 12% return. But you already have a 37% return. So now you're adding your 12% return to that. That became a 49% return in year one. And that's a very simple example. That's pretty cool. And I don't know of a lot of other asset classes that you can do that, guys. I know of one, and I'll get you into a minute, but I want to tell you a couple other things. I've bought properties for 20% down, which is pretty standard. I bought them for 15% down, 10% down, 5% of my own money. I've bought lots of properties, guys, for no money out of my pocket. What is your return when you're measuring against zero? If you have zero money into an asset or an investment and you see a $1 return, your return is infinity. It's not measurable. And I've done that multiple times. And that's how you get started, right? I was a broke college kid starting this off. Almost $100,000 in student loan debt when I started this off, guys. You do not need money to do this. You need to learn some very basic concepts in how to structure deals, but you do not need money to do this. I am not made of money. I didn't come from all this money. I just learned some very basic concepts and how to use leverage appropriately. There is not a thing on this earth that I know that makes money better than other people's money. OPM, baby, other people's money. Get to know that phrase. If you don't have to put any of your cash outlay into the deal, that is a good thing. Save your cash. Do something else with it. But caveat and disclaimer, we need to talk about the reverse side of leverage. Leverage can also be very dangerous. You need to watch yourself. If you are leveraged, say to 90% like our example is, and your property goes down 3%, like it maybe would have in 2008, 3% loss on your property, it's worth $97,000. You didn't just lose 3% though, did you? You lost almost a third of your money. So it works the other way too. So when you do use leverage, you need to be very smart about how you use that leverage and know your market, know what you're getting into. And if you do know that, the leverage thing, you'll be very comfortable with, in my opinion. And I can teach you some more about how to become comfortable with that. I don't mind buying properties for no money down. I'm not worried that the value is going to go down. In real estate, not like the stock market, I get to determine that. My guys going in and remodeling, my marketing, the property management company I use, we get to determine the value of that property more than any other asset class I know of. Yes, if 3 of the major employers in that town went out of business, would I have trouble getting good tenants to pay their rent that were employed by those businesses? Yes, absolutely I would. So those are some macro factors that play into it. But at the base level, you get to control it in real estate. You get to control what the value is. If you want to remodel it and raise rents, well, you just added value to that property and you got to control that. I own some stocks. One of the stocks I own a little bit in is ExxonMobil. ExxonMobil does not call me every day and say, Nate, what do you think we should do in the Permian Basin down in Texas? What do you think, Nate? They don't ask me. Thank God that company would be bankrupt. I'm not smart with the oil industry. But the point is, you have zero control over that. You hopefully vet the companies that you buy stocks in and you know that the leaders are good leaders and will do a good job. But my point is, I love, and I think all winners do, that if it's to be, it's up to me. The ball's in my court when I buy a property, and that makes it so liberating to me. So this concept of leverage, guys, does not scare me at all. And maybe it should more than it does, but it doesn't. And I don't think it should scare you as much as you think either. And it is a very, very powerful thing for creating a return on your money. Let's get on to number 2. Number 2 is the tax advantages of real estate. Real estate has built in, or the IRS, I should say, has built into their tax code laws. People like to call them loopholes. I like to laugh. These are written laws that you get to deduct certain things and accept certain deductions on your tax return. Let's think about real estate. You get to deduct and depreciate the real estate. Over 27 and a half years is usually a rental property, or sorry, a residential property. Commercial property, I believe, is 35 years. And you get to deduct the improvements on the land, which is the building. You can't deduct the actual real estate, but you can deduct the building. Now, what is that building shown to do over many decades in the last several centuries? Well, the price of real estate's always gone like this. Again, there's the dips, but it's always gone like this. Yet you get to depreciate it on your balance sheet. I want you to think about that for a second. You get to depreciate a generally appreciating asset. I know of no other avenue or arena where you get to do that. Let's talk about some other avenues you get to depreciate. A car. You get to depreciate a car. And I should caveat this. I have a good friend whose family invests in classic cars. There is a very, very, very minute, small percentage, probably 0.001% of cars that are classic, and they would probably go up in value. And their owners got to depreciate them. But for most of us, my Mazda 6 outside, it's not going up in value. It might go to the junkyard in a year, to be honest with you. It's going down in value. I've already depreciated it, but it's going down in value. It's not going to all of a sudden, Mazda 6 2010s aren't going to come back into style in 2 decades. They're not, okay? And that goes for the vast majority of other cars. So it is a depreciating asset, and you get to depreciate it, which is nice. Another one that's very common are electronics, like a laptop for a business. You get to depreciate that asset. Are laptops going up in value, or is their technology every year becoming more and more obsolete because of new technology? Dumb question, right? Absolutely, they're becoming more obsolete, so they're going down in price. I can't think of another asset class that allows you to do what real estate does. You get to depreciate a generally appreciating asset, and that is incredibly powerful, guys. Incredibly powerful. I won't get into some of the other tax things, and I want you, if you have any like in-depth technical questions, you need to consult a CPA. I have several CPAs that work for me and on my stuff, and that's where I get my tax advice from. I'm not a tax expert. I want to put that out there, so seek out CPA advice if you want some. But we could talk about incorporating an LLC and the tax advantages of that. There are numerous tax advantages that real estate offers. In the news lately, I've seen a lot of high-profile people that are accused of not paying taxes. This is how they do that. This is it. The concept of depreciating, using losses over here to offset gains over here, is a door that's open when you get into real estate and you have businesses. You just opened a door to so many things with the tax code that are pretty neat and can be used to your advantage. And again, seek out a CPA if you want to learn more about that. But that's another thing that no other asset class has, in my opinion. No stocks, no bonds have these tax advantages. They just don't. Lastly, my third point about real estate is that real estate has everything that a stock or bond has. So if somebody wants to come and say, Nate, I believe in mutual funds. Mutual funds are great. I get a 8% return, plus maybe there's a 2% average dividend on my stocks. That's a very nice return. But real estate has that as well. I hope I've shown you that. But real estate, again, is generally appreciating 3-4% a year maybe. Just like your stock going up 3-4% a year. And if you buy for cash flow, let's think of cash flow as that dividend payment. Stocks could pay 1, 2, 3, maybe 4 or 5% on some good stocks. Dividend each year, they pay their shareholders that in a cash payout. Well, cash flowing rental properties do the exact same thing. They generally go up in value, and every month, or maybe you want to wait and just do it on a one lump sum at the end of the year, you get cash flow every month. And that continually comes down year after year. As long as you've taken care of the asset, it's rented out, and it should go up, right? What do rents do into the future? Are they going to go down? Is the cost of living going down, or is it going up? Well, it's probably going to go up. So your cash flow 10 years from now should be assumed to go up. I don't always draw out and forecast that, but I know that's probably going to be true, right? My rents on my properties 10 years from now will go up, just like the stock will. Hopefully the dividends will. And I think it's got the potential to even go up more than stocks do. So anybody that wants to tell me that a mutual fund or a stock or a bond has these things, real estate has these things too. It absolutely does. And so I would throw that against that argument all day. And guys, I am sure that there's somebody out there like, no, Nate, this is a better investment. I'm not saying that this is the best investment again. I would debate somebody on that and tell you that I think this is the best investment I've seen, and there's a little bit of technical knowledge you need. However, there's technical knowledge you should have if you're investing in the stock market, bonds, mutual funds, etc., etc. You should have some knowledge. So yes, there's some things you need to learn to be able to do this, but it's not that hard, guys. And I hope I portrayed that the juice is worth the squeeze. The return is there if you want it. And those three things, the concept of leverage, tax advantages, and the dividends and the general appreciation that a stock or a bond hopefully has, are the three reasons I feel that real estate is a very, very, very good investment class. And I hope you take a look at it. Thanks.